everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. We are on the Fed watch. Speed limit now 25. Following the September FOMC meetings, much ballyhooed, I love that word, 50 basis point rate cut, the voting members scaled back on their magnitude and reduced Fed funds by 25 basis points this time around. So as a result, this brings the new Fed funds trading range down to 4.5 and 4 3/4. Now, regarding the future course of monetary policy, as I've been emphasizing for a while now, the money and bond markets are going to be continuing to adjust their pricing mechanism towards what this rate cutting cycle will ultimately look like. And a data-dependent monetary policy world, that's going to leave plenty of room for further speculation for not only the December Fed meeting, but perhaps more importantly for 2025 as well. Now, one important aspect that comes to mind is a visible difference in the narrative that accompanied the November Fed gathering as compared to back in September. So let's go back 6 weeks or so and remember what assumptions the Fed and by extension the money and bond markets were operating under. First, the economy/labor markets could be cooling more than previously expected. Progress on inflation was continuing, and this would result in an aggressive Fed rate cutting cycle. At one point, the implied probability for Fed funds futures was looking at a 280 target by fourth quarter of next year, and Treasury yields had plunged by 100 basis points. Let's fast forward to the present. The intermeeting data has revealed a continued resilient economy, with the pre-hurricane strike-related labor market showing signs of not being as cool as originally thought. And inflation numbers hit a little bit of a roadblock. Now, needless to say, these developments completely changed Fed rate cut expectations, with Fed funds now being discounted to be at roughly, let's call it 360, 370 by Q4 of next year. And Treasury coupon yields are all back being over the 4% threshold as I'm talking to you today. So where do Powell and company go from here? Well, obviously, monetary policy remains highly data dependent. Another quarter point reduction in the Fed funds rate seems a likely scenario for the December FOMC meeting, data permitting. But this is where things could get very interesting. If the economic/labor market data continue to show signs of not cooling too much, inflation gets sticky around current levels, maybe a reasonable case scenario involves the Fed taking a pause to reassess things to begin 2025. And that doesn't necessarily mean the rate cut cycle would end. However, the policymakers would have already cut rates by 100 basis points in this backdrop. So perhaps Powell and company taking stock could make some sense. Now, is there anything else investors should be on the lookout for from the Fed? How about their future plans for quantitative tightening, QT? The policymakers have already tapered their pace of balance sheet reduction, so it wouldn't be out of the question at all if the next step in the months ahead would be to end QT at some point in 2025. What's the bottom line? As we've seen so many times over the last few years, monetary policy will remain a fluid process, and this rate cut cycle will more than likely be no different. So I'm going to end it there. Have a great rest of the week, everybody.